What is your take on the property market and property prices and where to from here?
Yeah, so I was very fortunate to catch up with one of the major banks CEOs recently, and we're talking about the property market and where do you see the market going? And the response was, we can't see the market grow at 20% year on year, and that's coming from a major lender, which almost then suggests that the banks now have been tasked by the RBA to then effectively call the property market. Yeah. So there's just little changes that are coming through. So you mentioned before about the assessment rate. So when someone goes to borrow, the stress test is now bumped up to say 5.75, which on average reduces someone's borrowing capacity by about 5%. Not a lot, but it just kind of means that if I'm going to my absolute limit to make an offer, my maximum, especially for first-time buyers or upgraders, my ability to make an offer is now dropped maybe by about 5%. That's one. Fixed rates have gone up, which means people are now staying a little bit cautious about how much they borrow, for example, what that means for their cash flow for the next 4 to 5 years. So just these little tweaks, for example, and now just going, right, people going, okay, well, we don't have to rush out and buy a property overnight, which was kind of that frenzy that we had for maybe the last 18 months. And we're seeing that now in what we call stock levels. So property listings have now gone up. It's always that way just before Christmas. So I guess Q1 next year will be kind of a really good litmus test for the property market to go, well, how many properties are coming on? What is price expectations, for example? I don't get too hung up on auction clearance rates because there's kind of like a few grey areas around the reporting on it. But vendor discounting, and I think when I speak to a lot of real estate agents, people listing kind of now or coming into this market still have expectations for maybe the last 18 months, and the market is slightly starting to move and change a little bit. And greedy vendors will get found out. And as people have more options with the supply that's coming on, that demand will then start to taper out a little bit more. And I think, again, I'm hearing a lot of businesses now getting to a rhythm of, okay, team members have to come back into the office for a specific couple of days. And that means, you can't work from the South Coast 5 days. You actually have to come into the office a couple of days as well.
Yeah.
And that may just start to kind of make a few people think, okay, well, look, we can have the best of both worlds. Can we be halfway from the coast to the city, or do we just kind of move back to Sydney? And I think some people that were on the fringe may actually decide to move back to Sydney as well. So there's just those little dynamics at play, Ben, where you go, right, we know that the market can't do or won't do another 20%, particularly for Sydney, Melbourne. Brisbane is one market that's still pegged for some great things over the next 2 years. Olympics being one that's a longer term, but more so interstate migration, as people kind of chase a bit of a lifestyle as well, and also bang for buck. Brisbane's become that runner at the moment.
Yeah, I'm seeing a lot of activity Brisbane and the Gold Coast as well. There's a few clients that have started looking up there because there was a bit of affordability, and a lot of people have got sort of medium-term plans to relocate out. And I think we're seeing more workplaces be flexible with their working arrangements. And you look at spending $1.5 million in Sydney, and you get like a cramped 3-bedroom house, 15 k's from the city.
If you're lucky, that needs a lot of work potentially as well.
Yeah. And then you look at Brisbane or the Gold Coast, and you're getting a 4-bedroom house with 1 or potentially even 2 cupboards in the hall. So,
and you're getting like 750 square meter block for that sometimes as well. So you go exactly pound for pound, and so if you can still hold your Sydney income, but buy a property at say 1.5 with a little bit more space to roam, it can be a no-brainer for a lot of people are going, hang on, we can get a lifestyle for our family that we couldn't have afforded, or meant mortgage themselves up to the eyeballs to be in Sydney, for example, as well.
Yeah, absolutely. I think one of the things that I've been thinking about lately with the fact that a lot of people are talking about property markets, we're talking to a few people, and I think it's sort of reminding me a little bit of the COVID lockdown price. Like a lot of people were waiting for the JobKeeper to end, and they were talking about the property market collapse, and oh no, I'll just hold off because this is going to happen. And you've got all the partly sort of media potentially hyping things up a little bit there because a lot of people are interested in property, but people are waiting for these declines. In my view, it's probably seems pretty unlikely that it's going to happen. To your point on, chatting with the banks, I think that the big banks, these multi-billion-dollar companies, and then the RBA, who is the sort of the steward of the economy, they are incredibly invested in ensuring that property values don't decline, because if they do, then household wealth on the RBA side, household wealth levels will decline, and that's bad for people spending money, bad for the economy, definitely not what they want to happen, which is probably why they haven't increased interest rates already. And then on the bank side, if people start losing money on properties, ultimately they're the biggest landowners in the country, because they're the ones that have got the mortgages on all of these places as well. So my take is that they'll probably be, like you say, that they're focused on how do we slow things down, because they know that if they just keep going and going and going, that's unsustainable, and there would have to be a decline. But if they can slow that growth, then the property price.
That's a good market growth. 7-8% year on year, for example, capital growth that's manageable. The bank's resources are absolutely stretched at the moment. You see that from bank turnarounds. So the banks, while they're delivering a lot, their margin on home loan delivery, so trying to make a profit on it, they make it it's almost like car finance, right? The car dealers will sell the car for next to nothing, but then make their money on the finance. So to produce a loan and sell a loan for a bank has become very expensive. It's time consuming. It's been competitive from a rate perspective, but now it's kind of that shift back to they can make a bit more money on the loan, and the turnaround times aren't 30 or 40 days to get a formal approval anymore. That's going to stretch that back into somewhat of a normal time frame. Because again, trying to find talent for banks and trying to find assessors for banks has become incredibly challenging for them in this market as well. So there's quite a lot of, you see the kind of dynamics come together. You mentioned that the big banks control the property market. We want to see consumer confidence kind of continue. We want to see business confidence continue. That's where investment will come and spend will come. You won't get that if the property market hits the absolute wall. And I just look at it going, man, we got through a GFC, we got through an international pandemic, and the Australian property market still trucked on. Like, geez, this thing is damn resilient. And people are waiting. As long as I've been doing this, people have been waiting for a crash. And just show me where it's been. We've had interest rates at 17% in this country. We haven't had a crash. So things will slow down, but you don't see a 20% reduction in Coogee, in Mossman. By blue chip, good quality areas, you don't see drops in good quality properties and good quality areas. Things will slow in some particular pockets as well. That's normal for a property market. Not everywhere can be on fire. But if you've bought well and you've bought a good quality property, what are you worried about?
That's right. And I think people taking a long-term view should take comfort in the fact that there is that investment from the banks and the RBA, but also the fact that we've gone through in the last couple of years, we've gone through this period where there hasn't been a lot of wage growth. I think in a big part because a lot of companies have been quite nervous about the pandemic and economic security and ongoing lockdowns and all of that sort of stuff. But the reality is business hasn't been that affected because all of the governments all around the world have been dishing out cash like it's going out of fashion. But now I think that we're probably set. As someone that we've been hiring, I'm seeing a lot of and I know that you guys are active in the hiring market as well. A lot of people that I talk to are looking for people, and like you say, that there's this talent gap that wages are probably looking to increase over the next little bit. And I think as that wage growth continues to grow and property doesn't grow at this massive rate that we're seeing, then prices become more affordable, and that's what's going to drive the longer term growth of the property market and where the money is going to come from anyone that buys today, even knowing that they're buying at 30% more than what they could have bought at 2 years ago.
It's a great message for people that are in roles, in salaried roles. I'm like, this is a great time to be alive for you. Think about it. There's such a talent shortage. I call it the war for talent. Talk about the great resignation, whatever it's going to be, but it's, as an employer, you don't want turnover in your team. That's one. You want to keep and retain good talent. That's another. But also to try and find someone to replace a high quality team member, you got to go through recruitment, you got downtime for your business, you got impact to your customers. It's like, well, hang on, we will actually pay more to hold on to some talent as well. And a lot of businesses are realizing that, going, yep, we have to pay. And then people have worked incredibly hard. Like, they've done the hours over the last 2 years, just going, yeah, we need to reward and recognize that talent. So we're going to see true wage growth actually pick up, which I think it's great for a lot of households as well.
Yeah, absolutely. And it'd be interesting to see. I think that there's a bit of a lag on those statistics, but as the numbers come through for the next year, like what they end up looking